Alright guys, so I'm gonna go over option trading briefly. Just want to point something out. So this is what I did today. This is what I traded. I put a call on PLTR expiring November 27th, and then I put a $19 call for $1. I purchased the price for $1 right here. So I bought 20 shares, 20 contracts. So you multiply those by 100 for every share. And then as the price was going up, it went up to 120. I cashed out right here. I made $400 solid. I cashed out, closed out the account, and then I actually went back in and I bought it prematurely. I bought it again. So it went up, and as it was coming down, I bought it $1 again, bought the same contract, but it kind of dipped a little bit lower. But now it's kind of recovering, so I'm not worried about it. But this is what I want to show you. So I bought it for $1. And as it started going down, it got cheaper and cheaper. The price was at like 0.875 or 0.85, and it kept going down. So what I did is I pulled a Danny P. And for those of you who don't know what a Danny P is, it's when your stock is going down and you're losing money, you just go ahead and buy more shares to average out the cost. So you go all whale. You just drop a shit ton of money on your stock. Oops, this is going on YouTube. Who cares? But yeah, so you drop a bunch of money, you buy more and more shares to average out the cost, and then as the stock goes up, you recover your money pretty fast. So what I did is I pulled the Danny P on this, and my purchase price dropped. So we're gonna go to an option calculator right here. I like to use this option calculator actually. I go for long bullish. I'll open that. And then over here, I'll tell you long bullish calculator. What you're going to do is you're going to put symbol. I'm going to put PLTR. No, my bad. PLTR. So it's 790. That's when it closed, I think. It's at 1835 when I last looked at it. So you're going to have to select the option. I'm going to go to November 27th. We're going to do that. And then we're going to scroll down to the $19 call in the middle. You see this right? Nope. Sorry. My bad. This one right here, the $19 call. And then I'm going to choose this option right here. No, I put 20, my bad. I meant to say $19 call. I'm going to choose the $83. But I bought it at $1, and I averaged it out to 94 cents, 94.19. That is what my current purchase price is after averaging it out. I bought 41 contracts. And donezo, we're going to hit calculate. So over here is going to show you a quick brief. It's going to say estimated return on PLTR 18.35 November 18th, which is today. You're going to have your entry cost. So that's how much it cost me to buy all those shares. It's $3,854. That's your maximum risk. So that means if the stock goes sideways and it falls and it keeps failing, your maximum risk, you're going to lose $3,854. Now, over here it also says maximum return is infinite on the upside. So once you break even at 1980, that's just infinite profit. This is where the misconception happens. So what happens with the misconception is that people think that as soon as it drops at 1980, once it hits 1980, you start making your profit. But since the stock is not expiring tomorrow, there's still more value to it, so it keeps moving. And you have, I put it at 27, so it expires on the 27th. So let's just do this real quick. Let's screenshot this right here. Let's edit this right here. Do a little edit with the markup pen. And so if you zoom in, we're going on the 27th. We're doing a, so that's when it expires. So all this right here in white is your break even on those days. So you're going to start by tomorrow. We're going to look tomorrow at 19th. And we're going to say at 19, it's going to be, let's see how you move the stock right here. So on the 19th, if you scroll down to 1870, that is where these two meet on this little box, the white box over here. Let's undo all this stuff. So you have right here. So you're going to go 19th, and we're going to move this a little bit to the white box is 18. Oh my God, it's annoying. So on 1870 right here, and then you come down here and your break even is at that little white box in the middle is 1.06. So tomorrow, if the stock hits 1870, I'm going to be in the white. So that means I'm breaking even because the stock price or the purchase. So the purchase price was 0.9419, but the buy-in price is going to be 106. So that means if I close it out tomorrow at 106, we can hit delete and close this out. Go back here. If I buy it tomorrow at 106, I'll be making $41. I'm pretty much breaking even if I sell it at 106. But then if the stock goes to 880, the price will be 600. Right here, it's gonna be $600. Sorry, it's gonna be $6.38. I'm making $246. If it goes to 890, it's gonna be 11.7. It's gonna be worth 451. If it goes up to $19, I'm making 656. And then all the way up to where it breaks even, right here, I'm still making money. I'll be making $2,000 or $2,500 off of this. So the misconception is that you only make money when it hits the price because the call is at $19. I put $1 on it, or 0.9 something. So you add those two up, and your break even price will be the 1980 right up here. But that is the misconception, because as the price goes up and it drives, the value of the stock will go up and you will make money. This is just a brief rundown. I might have to retake this video and do it on my laptop with a little bit more drawings and try to explain a little more in depth. So I'm gonna post this like my first video on options. I'll get some feedback, and if I have to, I'll retake this video. I'll retape the whole thing, and we'll talk a little bit more about it in a more clear explanation way, I guess. All right, thank you.